Good morning. This is Niaga AWANI. Early on, we just heard about some of the day-to-day issues, our live coverage with our colleagues, Nina, the producer, as well as Harits. The conversation still is ongoing. Stay tuned to Astro AWANI for the continued conversation of consumer price index, inflation, and many more. For now, we have to discuss a little bit more about some international affairs, in particular more about Trump's cabinet picks that IQI Holdings is going to share with us. Joining us on the line is the Chief Economist for IQI Holdings, Shan Saeed. Shan, in your previous interview, you said that oil prices will meander around $77 to $117 a barrel for 2022. It has already hit the market and surging ahead. What's the new forecast for second half of 2022?
Ibrahim, last month I was talking to the Canadian investors because we have got office in Canada, and I have shared with them that for H2 we foresee prices between $110 and $150 per barrel. It is based on the premise that demand will continue to be on the upsurge. There will be supply hiccups, and we expect oil prices to stay on the higher side. And that will put a huge pressure on those economies that are importing oil. So we expect oil prices to stay higher, and this will be the hallmark for H2 2022.
Okay, Shan, very recently Jamie Dimon, a person that I actually look up to, said that the economic hurricane is going to befall us. He was just making some instruments reading, particularly when we're looking at the US's inflation rate, how the Fed is actually trying to raise the prices, and how all this basically indicates to a recession that is looming ahead. Having said that, JP Morgan's Jamie Dimon also said that oil prices from 2022 will hover between $150 $170 a barrel. Goldman Sachs mentioned $140 per barrel. Do you think that these figures are actually realistic and pragmatic? And do you think that we're going to go back to that 2008 era where oil prices actually hit about $147 a barrel?
Yes, Ibrahim, absolutely. These figures are quite realistic and they're very pragmatic, taking into account the geopolitical risk is getting deeper into market, the demand is coming back, there's supply hiccups, and we have seen the way the energy market has stayed volatile in the last 1 year. We are heading back to the same era of 2008, when on 11th July oil prices were trading at $147.17. So I think we are back to that era after 14 years. And not only 22, we expect oil prices to stay higher for 23 as well. So what these gentlemen are sharing, I think it's very pragmatic, realistic, and that is coming into the market at a very fast pace. Some people are still in denial and they expect oil prices to go below $100 per barrel. That is not happening. I think oil prices for summers will be around $135 on the average.
Shan, let's take a look into other commodities as well, because not just oil, but gas prices are up in the US market. What do you think would be some of the major indicators and factors of rising gas prices that could be seeing greater up jump? For instance, gas prices are up 104% since January 2022. Do you feel that more is at stock right now?
Yes, absolutely. You have mentioned that gas prices are up 104%. And if you see what is contributing to the gas price, especially in US and other market. In US right now, if you go to California, the prices are $7.50 per gallon, the gasoline prices. You go to Michigan, it's $6.50. You go to Chicago, it's $7. If you go to Baltimore, you have different prices. But in 21 states, the average gasoline price is around $5 a gallon. So what is actually contributing? I can give you a percentage down. 54% of the natural gas prices come from the crude oil cost. That contributes 54% to the gas price. The second is the refining cost. That contributes to 14%. The third is the taxes that contribute 60% to the gas price. And the last is the marketing and distribution cost that again contributes 16%. So these four factors are the major contributor to the gas prices. And right now, when I speak, I can see in front of my screen, gas is trading at 8.66, oil is up $120 per barrel. So I think gas prices, I wouldn't be surprised if it touches between $9 and $10 by the end of this year.
Analyzing the macroeconomic outlook and going deep into some of the scenario analysis, can we expect oil prices to come down anytime soon? Or do you think that global economy should expect high oil prices hitting even $200 a barrel, maybe towards next year? What's the probability, you think, and the various factors moving into this? I want to look into perhaps some of your comments on the geopolitical risks, the petro-yuan payment, petro-yuan payment to Saudi and China, and of course Russia's declining production. There's also the story of OPEC calling the shot with Saudi and Russia, supply hiccups with a bunch of other stuff happening. What do you think is happening right now?
I think the way the market is shaping up, I would not be surprised if oil touches $200 per barrel by next year. And it is based on the premise you have mentioned many. I think all these factors are very much there and they are very relevant to the market. So I think the way the market is shaping up and the way the supply hiccups are coming and there is surging demand. One factor that is quite significant is the Chinese demand that is still slowed down because of the lockdown. So I think we expect at July IQI that once the Chinese demand it comes back to the market, the oil prices will stay on the higher side. Right now, when I speak to you, the demand for oil on the average is between 93 and 97 million barrels per day. And by end of this year, we expect oil demand to touch 100 million barrels per day. And for next year, we're expecting the demand to be touching between 105 and $110 million barrels per day. So that clearly indicates that oil prices are on the upsurge, and this will lead global economy into a deep recession. So we have been saying for quite some time that global economy will only recover in 2025. For the next 2 to 3 years, we expect a lot of fragilities in the global market, a lot of bazooka in the equity and bond market, and volatile oil prices will keep investors on their